Good morning, everybody. Thank you very much, Steve. Can you hear me at the back? Mic working? You can? Nod at the back? Yep. Got nodding and waving at the back. That's good news. Steve made reference to it at the opening that it's hard to believe that the road to RDR started in about 2006. Back in the days when Twitter was a sound that birds made, and angry birds was usually a description applied to seagulls attacking tourists. It's also good to be in a fabulous location like this. These are beautiful buildings, and to be in a library surrounded by quite so many books is quite an awe-inspiring sight. It's a shame, actually, because shortly after this conference, they're going to actually refit the room. The books are going, and there's going to be a very large desk and a Kindle instead. Okay, then. As you will all know, Barclays is one of the leading UK banks. We've got over 1,700 branches, and we serve about 15% of the UK retail banking market. We serve all segments of the UK population with a very broad proposition. And in terms of investments, we offer a select range of Barclays and third-party funds through an execution-only online platform. I'm going to talk more about that later on, because obviously part of the reason we do that is because of the impending RDR. Today, I've been asked to talk about capitalising on brand strength in a post-RDR world. And I suppose the summary is, whilst having a strong brand is going to be a huge advantage at a time when the market is going through substantial change, it's not going to be sufficient, and nor may it be the most important factor. RDR is going to fundamentally change the UK investment market. Charging for advice, we believe, will reinforce the existing trend for customers to both research online, but also to purchase online. And to do that without the provision of advice. Now, whilst brand strength may be an important factor, success will depend truly on innovation, on having the right proposition, which is both attractive to customers and ultimately, as was referred to by the previous speaker, financially viable. So what do we see as the key impact of RDR? Well, the key thing for us is customer, and we see this as obviously being hugely disruptive to customers, and a lot of this will not be news to anyone. Depending on the research you read, the expectation is anything up to about 30% of the IFA market may disappear. They'll leave the market driven by either a desire not to take the exam or an ability to pass the necessary exams, or a lack of confidence in their own ability to be able to sell advice to customers. In a sense, we've been far too successful over the years in persuading customers that they don't pay for advice. And now we face the challenge of trying to persuade them to pay. I think that's going to be a difficult challenge. So that will in itself create a pool of orphan clients. The other element in the IFA sector, I think, will be this move up market. I think generally accepted view that IFAs will increasingly look to their more valuable customers in their customer base. A very natural thing to do, those with the most assets, those most likely and capable to pay. But it's also worth bearing in mind, faced with that explicit charge for advice, I think a lot of customers will simply choose not to pay. And in research that I've seen, it's interesting to say that about half of customers would pay their plumber more than their IFA, which is a somewhat frightening prospect given the expectations in the IFA sector about what they think they will be able to earn. So together, these factors are going to lead to a situation of huge change. And for those optimists amongst us, I think that's going to mean a very large number of broken relationships, which is a very large opportunity. An opportunity for new players, an opportunity for some of the incumbents who have successful models that can work in a post-RDR world to rebuild their businesses and attract new customers. So what's it likely to take to attract them? When it comes to choosing investments, whilst obviously features and performance are key, although quite why performance is key given that past performance is, of course, no guide to future returns. Relationship, interestingly, is almost equally important, and below that becomes reputation and image, and that's effectively brand. So between those two, you've got two major factors which dominate low fees, low risk, and remarkably, IFA recommendation. So that sounds like a great news for people who have established relationships, distributors who therefore have large customer bases, have an access to customers, and have a brand and a reputation which customers trust and view positively. So who falls into that category? Well, it looks like great news for the banks. In terms of unprompted awareness and consideration, they dominate a lot of the other players in this sector, including people like National Savings, the asset managers, and the life companies. So that would tend to indicate that it looks like the banks are going to be winners. But will they? Will it be that final occasion where the bank assurance dream is delivered? I've worked in this industry now since the early 90s, and as an exec in a life company, we saw this threat of bank assurance coming over the horizon, which never quite arrived. But maybe at last, with great networks and huge customer bases, they will win through. But perhaps not. The key is customer behavior is changing, and we're seeing some major trends. The percentage of customers using internet banking has increased from about 10%, or thereabouts 10 years ago, to nearly 50% today. And whilst for investment sales, we've seen phone sales overall decline, even branch sales now have flattened off. So we're seeing a significant shift to the use of the internet. And over the last 3 years or so, we've seen those sales double. So increasingly, customers are going online. It's not necessarily about a face-to-face conversation or even picking up the phone. It's all about ease and convenience and customers wanting to transact when they want to transact rather than when their distributor or product provider chooses to. Such trends can obviously reshape an industry. And we don't have to go far to see what can happen. If we take the motor insurance sector, if you go back 50 years, the likes of Swinton and brokers dominated the market. And in the 1960s, Swinton were the first to go on primetime TV to advertise to customers. And that was the dominant model. If we fast forward to the mid-80s, Direct Line was launched, going direct to customers, cutting out the broker, and using the telephone as a distribution channel. That very rapidly dominated the market and became the preeminent model, and Direct Line became the leading player. But not even they have successfully dominated the game. Again, with the rise of the internet, we're now in a world where the aggregators have taken over. And it's now estimated, I think, that something around about 40% of motor sales are through aggregators. So even when you think you've got a winning model, it doesn't necessarily mean it's going to stay that way. And again, it's that trend. Customers want choice. They want to be able to go and transact when they want to transact in their own time. And it's not just in financial services. So if we go to other sectors, it's also clear that having a big brand and a dominant position doesn't necessarily mean you're going to win. So Borders, I think the #2 bookshop chain in the US, founded in 1971, dominant player, collapsed in February last year. Declining sales and a rapidly changing book market. It was no coincidence that 2 months later, Amazon announced that e-book sales had exceeded paper book sales for the first time. Woolworths, 100 years of successful retailing, went bust as customers increasingly went online to buy toys and gifts. And Blockbuster, who I think everybody would recognize as kind of the name in video shops, failed in September 2010, following an increase in competition from online players, so the likes of Netflix, who are coming through now, and other online service delivery mechanisms such as Sky, On Demand, etc. Even Kodak, and for a very keen photographer, which incidentally is how I got into motorsport, even Kodak, 133 years, probably the most famous name in film, failed earlier this year, unable to adapt their model And interestingly, curtailed by the fact that they were dependent on that film market as a big part of their income and didn't want to cannibalize their existing model to build a new digital model. Perhaps an interesting lesson for some players in the industry at the moment. So brand is clearly an advantage, but it's not sufficient. So what you really need to be successful is to be innovative. And just to blow our own trumpet for a moment, Barclays does have a track record in innovation. And in fact, I only joined Barclays in October, and so some of this was news to me, because I wasn't a great follower, nor should I admit was I a Barclays customer. So in 1967, the very first ATM in the world was a Barclays cash machine. It was unveiled in that technological hotbed of Enfield, North London. And that was followed in 1966 by, it was preceded the year before by the launch of the first credit card in Europe, which was Barclaycard. 20 years later, in 1987, we created the first debit card in the UK. And we've continued to evolve our business. We were the first to roll out contactless cards, extremely useful for those of us who shop by giant water slide, for those who remember the advertisement. And most recently, just at the start of this year, we launched Barclays Ping It, which is a very interesting innovation which allows individuals to transfer money to each other with another user merely using their phone number, which now means that you can't avoid that sharing the bill in the restaurant, and has been a huge success. We had something like 120,000 downloads in just the first 5 days. So getting back to the point as well, what are we doing in terms of investments and what do we think is important in a world where customers are increasingly going online? It's about trying to educate them. And we launched recently a fantasy investment game that allows customers to use virtual money to invest in the funds that we have in our existing platform to learn about investing. Yeah, we've got to recognize the fact that in a world where increasingly customers won't have an advisor and won't have somebody to talk to, that it's going to be through games and other tools and vehicle methods that we're actually going to be able to help those customers understand why it's important to them. So how do we combine brand strength and a track record innovation to address the challenge of RDR? Well, the answer is we developed a new proposition, and this story goes back about 18 months. We made a very tough decision, which was to close down our face-to-face advisory force that we had in the branch network. That was a tough call. It was driven by a number of factors. Obviously, regulation makes such models financially challenging. And frankly, we weren't confident that we had a model that would be able to charge customers enough for the advice that would both be good value for them and create value for the shareholder. We also wanted to recognize the fact that customer behavior was changing, and they were increasingly going online. So we've developed a site which provides tools and videos and information to help customers learn about investments. And by restricting the fund range, and we have just over 70 funds, which are a mixture of Barclays and third-party funds, we made it easier for them to choose. And through the online site, they can buy, sell, switch, and monitor their investments 24/7, whenever they want to. Furthermore, to make it easy for them, just recently we've integrated the investment proposition with the online banking platform. So customers of our new online banking offering will be able to see their investments without the need for another sign-on in the same place as they see all their banking products. So it's bringing together investments and retail banking into a single place. And finally, the improved economics means that we can offer tracker funds at 20 bips, which is interesting seeing the 25 bips, without an initial charge, without currently a dealing or an account fee. So it's transparent, it's simple, and it's easy to use. So to conclude then, in summary, we think brand strength is a great foundation to build on, that existing customer relationships will be an advantage in the future. However, the true key to success in RDR is going to be around the model. It's going to be about being responsive, it's going to be about being innovative, and it's about being able to create simple, easy-to-use propositions that will enable customers to help themselves. We believe we're delivering that now, and we look forward to the challenge of RDR next year. Thank you.